Hi, this is Michael O'Leary from Buy the Book Taxes with another video in my series on IRS collections. Today's video is going to be about what's known as the 10-year collection statute. If you are enjoying these videos, please hit the subscribe button and the like button. The IRS has 10 years to collect balances due from taxpayers. There are some important points to understand about this 10-year tax period. It's not 10 years from the year of the tax return. It's 10 years from the time the tax return is filed and the tax is assessed. For example, let's use tax year 2010 as an example. Assume that you file a 2010 tax return on April 1st of 2011. The IRS has 10 years or until April 1st of 2021 to collect that tax. After April 1st of 2021, the 10-year statute will expire and the tax will be written off. So it's very important to understand that it's the filing and the assessment that starts the 10-year clock. It's actually the assessment, but I don't want to get too technical. The assessment usually occurs shortly after the filing. Now, in addition to that, there are several actions that a taxpayer can take which can cause the 10-year collection statute to be extended. The technical terms that are used to describe this are called tolling events, like a toll on a road, T-O-L-L. Another term that's used is freeze, to freeze the statute in place. The reason this occurs is that after the taxpayer takes these actions, the IRS is not allowed to continue collection efforts. So whenever they have to stop while an action that the taxpayer engages in is under review, that stops the 10-year statute. And once that review is completed, the 10-year statute will start up again. I'll give you some examples of these tolling events that freeze or toll the statute. Let's say you have a balance due. You owe the IRS $20,000 and you submit a form to request to get into an installment payment agreement with the IRS, a monthly payment agreement. It takes the IRS, and this was even pre-COVID, 30 to 60 days to review this installment agreement request and either approve or deny it. During that period, while they're considering it, they are not allowed to take collection efforts against the taxpayer. So let's assume it takes 60 days to approve it. Once that agreement is in place, that 60 days will get added on at the end of the 10-year statute to extend it another 60 days. Likewise, if a year into this agreement, a taxpayer defaults, that automatically adds another 30 days to the statute. There are several other tolling events. I'll go through them quickly. If a taxpayer files bankruptcy, that will toll the statute, because while the taxpayer is in bankruptcy, the IRS is not allowed to attempt to collect debts from the taxpayer. So in case of a bankruptcy, the statute will freeze for the amount of time that the bankruptcy is in process. And then once it's completed or discharged, the IRS will add an additional 180 days on to the end of the statute. So it's the bankruptcy period plus another 180 days. If a taxpayer files an offer in compromise, attempting to settle the debt for less than the face value of the debt, that also freezes or tolls the statute. And for the amount of time it takes to review the offer and compromise, which pre-COVID was on average about 8 months, that 8 months after the offer and compromise was either accepted or rejected, that 8-month period would get added on. There's others. If one of the spouses files an innocent spouse claim, let's say there's a divorce and one of the spouses is looking for relief from joint tax debt that occurred during the marriage that has since been dissolved, while the innocent spouse claim is being considered by the IRS, the statute will toll, because once again, the IRS cannot take aggressive collection actions while they are considering an innocent spouse application. So that's kind of the outline of the 10-year statute, as well as the key thing to understand. It's not 10 years from the tax year itself. It's 10 years from the time the return is filed and the tax is assessed, and that there are numerous things that can happen that can cause the 10-year statute to be extended. Another one, which not many people realize, is if a taxpayer leaves the country for more than 60 days continuously. I actually had a client come to me and say, look, I had a balance due for 2009. I filed the return in 2010. 10 years is 2020. Why are they still taking money out of my bank account for the installment payment agreement I had? That should have expired. What the taxpayer didn't tell me, and I found out after doing a little research, guess what? The taxpayer was deported and was out of the country for 5 years. So once the taxpayer came back to the country, and the IRS knows this because their computers talk to the State Department computers, the IRS added the 5 years that the client was out of the country onto the 10-year statute. So I'm going to share my screen here and put my contact information up. So here's my business card, Michael O'Leary, Norwalk, Connecticut, cell, fax, email, website. And here are some of the services that I provide. Tax preparation for 1040 individual returns, estates and trusts, and then pretty much the menu of the tax resolution options. Payment agreement, offer and compromise, not collectible due to hardship, innocent spouse, penalty abatement, and I can also help with tax liens and levies. I offer CPA quality without CPA prices. So if you owe the IRS money, have years of unfiled tax returns, and need some help with representation before the IRS or a state, please give me a call. I can help. See you next time.